All right, so today we'll be discussing how to identify a trend, as basic as it sounds for as many of us who are new traders or newbies. You spent less than a year in trading the Forex market. This could be a very, very naughty and difficult issue. So I'm responding to the recent poll on my Telegram group, where majority of you are basically new, less than 12 months in the Forex market. There is every likelihood that when you join the Forex market for the first time, you would see things like this, right? You see charts, setups that look like this, and it could be very intimidating. It's bounce back strategy. You could see MT4 setups on your laptop that looks like this, right? You could see plain charts that look something like this. You might find, depending on who you're following, it might be someone who likes using moving averages, and you could have them in various shapes and formats, right? Or perhaps harmonic patterns, right? It could be a harmonic pattern type of person. Now, irrespective of what strategy you are exposed to, there are certain things that are like given when trading the Forex market. And I want to explain those to you, right? Part of the things you'll be taught in Forex 101 or Introduction to Forex is that the trend is your friend. You'll be asked to trade in line with the trend and not to trade against the trend. Now, it's a very, very common statement. The challenge most times for new traders is that in the heat of the market, sometimes it could be difficult to know what the trend is, right? And there are some confusions that also come in when in a higher time frame, the trend is looking bullish. The lower time frame, the trend is looking bearish. And there's that confusion between the trend. You can't predict. You don't even know how to spot out the trend, right? So I'll be showing us an easy way to identify a trend and now trade in line with the trend. If you trade in line with the trend, you most likely win most of the times. And if you trade against the trend, there is every likelihood that you get stopped out several times, right? More than your winnings. And so we'll be discussing the trend today and how you can easily identify a trend. First thing I'd like you to know is that price doesn't move in a straight line. Price usually will not move in a straight line. You could see that even on this particular chart, price came down, went up, came down, went up, came down, went up, and presently you could say is moving sideways, right? So price usually doesn't move in a straight line. You need to get that clear, right? So it becomes wrong for you to assume that a trend is bullish simply because you see some strings of bullish move, right? So it would be wrong for me, let's take GU as an example. It would be wrong for me or you to say you met price at point X, somewhere around there, right? And price gave 3 candles to the upside. And this is a 4-hour chart, by the way. So this 12 hours of moving in a particular direction. This is not enough to say that price is in a bullish trend, right? The same can be said for a 15-minute chart, a 1-hour chart, whatever the chart is, right? It would be wrong for me to say that price is bullish simply because I see strings of bullish move, right? Candles forming one high above the other is wrong. It would be wrong for me to say this is an upward trend. And it happens several times for most traders when we notice an impulse move, a push to the upside. We're still wondering, should I buy? Then you see another move. Ah, I think I should buy, but you're still not sure. By the third or the fourth one, you say, well, I think I'm going to take a buy now. And once you take a buy, you go into that trade on a buy somewhere around here. You notice some moves to the upside and you're so happy. Yes, I've made $1, 10 cents, 20 cents, and the market pulls back against you. Like, oh, well, let's see what happens. It pushes back up. Ah, yeah, I know I was right. Then boom, against you, and you hit and takes you out. The question is, why did you pick this? Right, from the example I just gave, we're assuming that you went into this trade because you saw consecutive bullish move and you were convinced, based on what you can see, that price is on a bullish trend, right? Remember, we always want to trade in line with the trend. But I'm here to demystify that erroneous thought that simply because you see certain bullishness in the market, that is enough reason to assume that price is presently bullish. That is on the backdrop of the fact that price usually wouldn't go on a straight line. So how do we predict, how do we know that price is on a rise? Let's take this example. So say we have from point 0, say we have price doing this. You could clearly see that this is a bullish move, you know, a bullish trend, right? Some persons will even come and draw a trend line like this, and another one, say like this, and say, okay, this is a channel, and they'll be selling at point 1, buying at point 2, selling at point 3, buying at point 4. It all depends on your strategy, right? We're not here to discuss the strategy. We're here to find a way of defining what a trend is and how to know that price action is in a bullish trend or a bearish trend. Now, if you're able to establish that price is in a bullish trend, then you look for buys alone. And if you're able to establish that price action and price itself is in a bearish trend, sell mode, then you now look for only sell signals. You look for only sell signals to give you an edge in winning. You definitely not win all of the time, but you have an edge at the end of the trading period. So how would we know that price is actually moving upwards, right? We need to see certain things happen to be able to establish that price is moving upwards. So let's say you notice that 3 candle to the upside, or 4 or 5. First thing to do is to wait for a correction, right? You should know that if you try to catch every peep in the market, you would wipe out your account. If you try to catch every peep in the market, you will wipe out your account. You have to be able to get to a point where you are patient enough to wait for certain things that looks like a pattern you understand, then you trade that pattern. That is the way to be consistently profitable in the Forex market. You will have some set of losing streak, but if the strategy is such that gives you an edge in the market, you will eventually break even and close with some form of profit at the end of the trading period, right? So when you notice 0 to A, that is not enough to say that price is in a bullish move. We usually want to wait for B to C to form. Then we can safely say that price is giving us a bullish trend. Now, usually, what you see in textbook and most Forex gurus will tell you is that that point 0 we could show delineate this as a low. So let's say this is low, right? So we have a low here. You want to have a low, then have a high there, right? So we'll have high. Obviously, A is higher than point 0. Point A is higher than our starting point 0. Now, point B is higher than point O, but it's actually lower than point C, but is a low. This low is higher than this low. So we call this point a higher low, right? So you have a higher low here. Point C is actually higher than point A. So that gives us a higher high right there. We have a higher high. So to establish an uptrend, you have to see two highs and two lows, right? So a low, a high, a higher low, and a higher high. This is what constitutes an uptrend. This is when you can say that price is in an upward moving trend. This doesn't say that price will eventually move upwards, but this is saying it is safe to assume that price is moving upwards. The question now becomes, why didn't we stop at point B and say, look, price is in an upward trend, just at point B? Because price could move, not take out A, and then drop lower, right? Price could actually form an M with C not taking out A. This is not an uptrend. So to establish an uptrend, you have to be sure that C has taken out point A. Then and only then can you vouch for an uptrend. C could close somewhere beneath A and B, between A and B, I beg your pardon, and then circle down lower. And this is no longer an uptrend. Remember, we trade in line with the trend. We want to be sure that the trend has been established before we key in to either buy or sell, depending on what we see, right? So for an uptrend to be established, you need to have two consecutive lows and two consecutive highs. A low, a high, a higher low, a higher high. Then and only then could you say that price is in an upward trend. Now for a downtrend, this thing is the same. So you start off from point that, correction, impulse, correction. This is a downtrend, right? We say this is a downtrend after we get two consecutive highs and two consecutive lows, right? So using our A to C, we'll say this is an established downtrend. Two highs and two lows. Two highs and two lows. Then we say this is a downtrend until C takes out A, right? Until you have a lower low, a downtrend has not been established. Price could as well stop at that point between B and A and then make a high. And this will be like a W, and this is not a downtrend. You only establish a downtrend when you have for an uptrend, I beg your pardon, you only establish an uptrend when you have a higher high formed. You need to have an higher high formed for an uptrend to be established, and you need to have a lower low formed for a downtrend to be established. I cannot overstate this, and that's why I'm repeating over and over and over again. Now, so how do we now trade these trends? So let's clean this up. Move it upwards a little. Sorry. So how do we trade this now? So say we've gotten a trend. We've been able to establish that we have an uptrend. We've been able to establish that we have an uptrend. So C has taken out A. Will it be wise for me to buy at point C, knowing that this is now an uptrend? And the answer is still no. Of course, you might have a strategy that tells you to buy from point A. Who am I to say no? But it's only logical to wait for the correction, which I'll call the wave 5. So let's take let's use this. So we have from 0 to 1. Now we have established uptrend. It's only logical for you to wait for this pullback. And then you buy from 4 to 5. Only logical to do that. Why? Why would you want to buy from 3 when you know that usually price will do an impulse and a correction, an impulse and a correction? If you buy from point 3, you could just buy and price start rolling down. Would you be able to hold on to this drawdown? Traders usually don't like drawdowns. Even if we know that we'll end up becoming profitable, we just don't like drawdowns. Now remember, there is nothing that is given that is 100% certain in Forex, right? So 4 could as well just pull back down even further, right? With your stop loss, with your account, be able to accommodate this pullback. So it's usually best to wait for certain bullish signals at point 4 to now go long, right? If the uptrend is established and the uptrend is going to continue, you could be sure of one thing, that 5 will at least equal 3 or take out 3. That way you have consecutive higher highs and higher highs, right? So you are sure that 5 would take out 3. But I would suggest you wait for 3 to 4 to form, then you now ride the 5th wave. You ride the 5th wave. That is the way to trade in line with the trend. We usually would trade the 5th wave, which is 0.4 to 5. Remember, I stated earlier that if you want to catch every peep in the market, you end up blowing or wiping out your account. If you want to catch 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4, you just have to be a genius to do that. And I dare say, even if you're a genius, you would run into some problems, right? You want to wait for 3 to 4 to form. Why do you want to do that? Because 3 to 4 can go as low as 2, and I dare say it can go as low as 1, right? There are times it could go as low as 0.0, even though this would have invalidated our uptrend. But you just don't want to jump in at 0.3. You want to wait for price to move to 0.4, then you begin to look for reasons to buy. Now, the reasons to buy all based on your strategy. You might be looking for crossovers, maybe of moving averages. You could be looking for overbought, oversold conditions in this case, as in this case, maybe an oversold condition. You could be looking for some momentum change. You could be looking for divergence. You could be looking for whatever your strategy tells you to do. But you just don't want to trade everything. You don't want to trade with 1, with 2, with 3, right? You don't want to wait, trade them. You don't want to trade with 1, with 3, with 4. You want to wait for with 5. You want to trade with 5. That is the best way to catch a trend. Now, because price can do anything. Price can do anything. Now, but let's look at textbook, right? We expect that 0 to 1, or rather we expect that 3 to 4 or 0.4 will usually make a U-turn anywhere between 1 and 2. So we expect 4 to make a U-turn anywhere between 1 and 2. And because this is an introductory class, I would want to start adding Fibonacci and the likes, where we start looking at, okay, price might be turning at the OTE or the 68 point, whatever. We don't need that for now. Just learn to see price action as it is. Then as you get more advanced and more confident of the charts, right? I remember mentioning earlier that things could get scary, right? But as you get more confident of the charts, on the chart, then you could add fibs and add several other things. Try not to cumber yourself up with so many things from the start, right? So from 3 to 4, we expect 3 to 4 to make a U-turn into 4 to 5, somewhere between 3 to 2, right? Textbook maybe at 0.1. From when it gets to 0.1, we begin to look for reasons to buy. So let me box this out. So price would generally make a U-turn from between 0.0 to 0.2, right? Or from between 0.1 to 0.2. So when price approaches 0.1, you begin to look for reasons to want to buy. When price approaches 0.1, you begin to look for reasons to want to buy. Now, in real life, price may not turn at 0.1. It will come all the way close to 0.2. And sometimes we could even see price weaken below 0.2, only to come back and close somewhere within the box, then give us a bullish reason, to buy, right? So it's also not wise to just buy at 0.1 blindly. You need to wait to see, have a reason why you're going in for a buy. It could be an engulfing bullish candle. It could be, a pin bar, whatever it is, whatever strategy you use. It will be wise to wait for your strategy to give you a reason to pull the trigger between 1 and 2. Now note that there are times price will not even get to 1 and it just moves upwards. So you might miss a trade. You might miss some trades, but no problem. You don't catch everything in Forex. We don't catch everything in Forex. But to be safe, I advise you wait for price to get to 1. Somewhere between 1 and 2, you pull your trigger once you get a reason to buy. And your first take profit, of course, should be 0.3. Because for a bullish move to continue, you'd know that 5 has to take out 3. And there you have it. That's how to, spot a trend and trade in line with the trend. But I must state here that what I've just given here is a textbook definition. And in real life, price is not as smooth as it is, right? So what you have on the screen presently, everything seems almost equal sized. But in real life, price could do something like this. Price could do anything. It could be very, very ugly. It could be very, very ugly, something like this. But just note one thing, that price is giving you, you know, that price is giving you consecutive highs, higher highs. You can see that consecutive highs, higher highs, and these are higher lows, right? It might not be as smooth, you know, as we have it to the left of the screen. It could be something like this. So let's go to the charts and see if we could find this out. But before then, I'd like to state that price is fractal. And by fractal, I mean, you know, if you go down to the lower time frame, you see something similar to what is happening in the upper time frame, you know, the higher time frame. And that causes a lot of problem for newbies, because you could go to the higher time frame and price is making higher highs and, you know, higher lows. Then you go to the lower time frame and it seems like price is making consecutive lows and you become confused. My advice is trade in line with the higher time frame and look for your entries in the lower time frame. Trade in line with the higher time frames and look for your entries in the lower time frame. So I'll give an example before we go to the charts. So let's take this out. And let's take this out. So we'll try to create a higher time frame scenario and a lower time frame scenario here and see, don't mind. So we have in the higher time frame, we might be having this push. Let's take this down here. In the higher time frame, we might be having something that looks like this. You know, consecutive highs, consecutive low, right? And in the lower time frame, let me take this out and use this. Higher time frame, we might be having something that looks like this, right? This might be what you see in the higher time frame. Whereas in the lower time frame, you're having something that looks like this. Lower time frame might be painting consecutive lows for you. Whereas in the higher time frame, you seem to be seeing, you know, a bullish move. Right? So my advice is this: you trade in line with the higher time frame. The higher time frame is telling you that you are in a bullish move, and the lower time frame is telling you that you are in a bearish move. Our advice: you trade in line with the higher time frame. Wait for this bearish move to get exhausted, and then look for reasons to want to continue to the upside. It's always wise to trade in line with the trend. Now, usually, this is what you see. Most textbooks will give you things like this, right? You'd notice that from the wave 0 to 1, it's longer than 1 to 2. 2 to 3, longer than 3 to 4. And of course, 4 to 5, longer than either 1 to 2 or 3 to 4. And that is the usual way a trend will be, right? So if there are aggressive buyers in the market, they take their profits or take a rest, as we might want to put it for retail traders, right? But it's just like in a football match, right? Soccer, you have 45 minutes in each half, but they also have halftime. The halftime is just a fraction of each of the half, maybe 10, 15 minutes, at most 20 minutes. You can't compare that with the 90 minutes that those footballers will be on the pitch, right? Why would you want to risk 3 to 4 when you could actually catch 4 to 5? Why would you want to risk 3 to 4? Why would I want to go with a lower time frame when I know that there's every likelihood that this push down will just be a correction synonymous to 0.3 to 4, and you should be waiting to catch 0.4 to 5, which will be this move right here. Right? If you have a strategy that helps you sell, please do. But I'll also advise against, I'm not a financial advisor, I'm just speaking from experience. I want to advise that you find one system of trading and stick to it long enough to become profitable, right? So if you jump in between strategies, you definitely not grow on time. Right? Forex needs some mastering. And to master anything, you have to spend enough time with that and pick one strategy that suits your personality and stay long with it, right? So the lower time frame could give you a down push, and you want to look for reasons to go bullish. That way, you can be sure that you last long in the market and you have big wins rather than chasing after small wins and now have big losses, which is, hallmark of new traders. So I would prefer you look for an uptrend or a downtrend or whatever, look for your trend in the higher time frames. Look for your trend in the higher time frame, then go down to the lower time frame to look for reasons to want to go trade in line with the trend, right? So if you are new and you've not gone through one of the videos we have here, trading in line with institutional order flow, part 1, I would ask you to please go watch that. So let's take this as an example. This is GU. You could clearly see that this is in a downtrend. And why is it in a downtrend? You keep seeing, you can see a high here, right? Then we'll see another high. We'll see another high, then another high, then another high, and another high, right? And you can find consecutive lows, 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 right? You can find them. Remember I mentioned earlier that on the live chart, things are not as smooth as we explained earlier. And I'll show you an example. Let me just clean up all the drawings. So come back to this. Can you notice something like this? Does it look like a downtrend now? Can you notice how we initially had 0 to 1, 1 to 2, at point 2, we weren't sure. 2 could extend all the way up, right? And we weren't sure that 0 to 1 was completed until we saw 2 to 3. As at this point, we're in a downtrend already. But we can't sell. We are not sure. Price might just move back up from here to do a correction. So you want to wait for this move to be completed. Once it was completed, you wait for a correction to be made. And of course, for a downtrend to be established, you expect 0.4 not to take out 0.2. You expect 0.4 to cause a turnaround somewhere between 3 and 2. Somewhere between 3 and 2. Usually around 1. But it could extend somewhere between 2 and 1 and then roll over. Right? So somewhere around 4, between 3 and 4, you would be looking for a bearish signal to go short. Your first take profit will traditionally be 0.3. for price to go downwards, for the downtrend to be sustained, you expect price to ordinarily take out 3, right? So first take profit at 0.3, then you could hold on to see what price would do depending on your trading style. Notice how price also made a correction, then a push down, another correction, and continued the move down. Very sweet, right? So you sold from 4 to 5. Let's say you got out at 0.5. Then you wait for a pullback and also sell from A to B, wait for another pullback, sell from C to wherever, right? Now you would be waiting for a pullback again. So you're waiting for a pullback, and you expect the pullback to make a U-turn between this point 0 to point C to make a continuation. Traditionally at point B, but it could make a U-turn. At least it shouldn't take out C, right? Then it turned down. Your first take profit will be 0.0, right? Then what did price do? Price broke 0.1. Let's draw 0.1 properly. It came all the way to this point that week, right? So price broke 0.1 here. And once price broke 0.1, you begin to know that this is no longer a downtrend. Because for a downtrend, you expect 3 to make a U-turn between 1 and 2, and also you expect 2 to take out this. 2, let's move this up, right. So you expect 2 to take out 0.0, which didn't happen. That's the first sign. Then 3 took out 1. We say structure has been broken. The usual structure is for you to have higher high, in the case of this downtrend, lower lows and lower highs. Now you have 0.3 taking out 0.1. When 0.3 takes out 0.1, this structure has been broken, right? This structure has been broken, but this hasn't established a trend yet. You still need to wait for a pullback. Say this is a pullback. Then you would be looking for reasons to want to buy, right? To want to buy to first take profit 0.3, and presently price is dancing in the form of consolidation. Right? So if you're trading in line with the trend, you want to trade 4 to 5 with first take profit happening at 0.3, right? You need to go to the chart and do lots of markup, lots and lots and lots of markup to get this. So let's look at another pair. Let's look at one of the most commonly traded pairs, EURUSD, and see if we could do something similar to EURUSD. Check out all drawings. Now, so we want to establish the downtrend or the uptrend or whatever here. So let's start up. This was the beginning of the move, right? I'll want to wait for price to close beneath this. Maybe I should start from there first. Then we can explain things better. So initially we were in an uptrend. Right? We were in an uptrend. We had higher highs and higher lows. Right? And now, all of a sudden, we notice price trading below point B. Once price trades below point B, we say structure has been broken. We say structure has been broken because we expect point 1 to make a U-turn between C and B, but it didn't. It came lower than B, meaning structure has been broken. Once structure is broken, we simply want to wait for a fresh trend to be established. And now we have 0 to 1 to 2. Then we had 2 to 3. 3 to 4. Right now we have 2 highs and 2 lows. We'll wait for the pullback, and we expect the pullback to end somewhere between 3 and 2. And we say traditionally at point 1. Then what do we want to do from there? We'll now sell when we have any sign of bearishness from point 4. We'll want to take this down and cycle even lower than point 3. First take profit at point 3 and you cycle even lower, right? For those of us who are not new to Forex, you might have a reason to want to sell at point 2 because this will be giving you a head and shoulder formation. But if you are new to Forex, I want you to leave out head and shoulder for now. Just understand the concept why we had to wait till point 4, right? This will give you an head and shoulder pattern if you are new to, if you are, not new to Forex. And usually we trade 2 to 3 in a head and shoulder pattern. It helps us to trade 2 to 3. And the basic thing is that 1 has to take out 2. Point 1 has to take out B for you to say this is a head and shoulder pattern. You expect you want this was initially an upward move. You want 1 to take out B to confirm that price might want to begin to roll over downwards, right? So usually what we do is that you have what we call the neckline somewhere at point A, right? So you want to sell at point A with your stop loss somewhere above, somewhere up there at point C. Then you sell off from 2 to 3. That's the head and shoulder pattern. But we're not discussing head and shoulder, perhaps at another video. Today we're looking at how to establish a trend. And if you're establishing a trend, you want to sell at point 4 all the way down. Notice how nice this sell-off would have been. Very sweet sell-off. And it gave you another correction. Where did it make its move? Somewhere around point 3. Then roll down even further, right? Then it made a push up and turned again at this point, right? Then roll down even further, right? Then made a push up and stop at point 2. Sweet. Roll down again, right? So this might have been the end of the downtrend, but usually we wouldn't know. So at point 5, we'll be looking for reasons to want to sell, with point 4 being our take profit 1. At least we got take profit 1. We never got a take profit 2. Price rolled over against us and closed at this point above the previous high. Now we say structure has been broken. We now begin to wait for a pullback and look for reasons to want to go long again, and the process repeats itself, right? Basically, this is how to trade the trend. So at every point in time, you have an idea of what the trend is, right? What the trend is. I want you to hang on for next video sometime tomorrow. I'll be explaining how to actually spot a trend on a higher time frame and how to trade with it at a lower time frame. But as a way of whetting our appetite, let's quickly clean out everything we have here, and let's do something. remove all drawings. Let's cut out a time frame here. Notice we were in a downtrend here. Boom, boom, boom. So we're actually in a downtrend at this point, right? Let me bring this down lower. We're in a downtrend. But notice that 3 to 4, 0.3 to 4 here actually looks like price is making a bullish move. If we mark up this point from 0.3 to 4, right? And we go down to a lower time frame. This time frame is 4 hours. Say we go down to the 1 hour time frame. Let's go back to 4 hour. What date was that? This was 16th, 13th, between 13th to 16th of March. So let's go back to the 1 hour time frame between 13th to 16th of March. Right. Notice what you have here seems to be an uptrend. Notice what you have here seems to be an uptrend in the 1 hour. And that's why I said that there are times that the lower time frame might look like it's giving you something different from the higher time frame, but it's usually safe to want to trade off the higher time frame. If you were buying off this point, right, there's every likelihood you could have lost this trade or just got something little out of it. But notice what you could have made in this move down, right? This move down, this big move down. Let's analyze this even further. So it was making something that looks like a push up, right? But notice at this point, this high here failed to take out this, and it rolled down, right? Giving you that head and shoulder pattern we spoke about earlier on. Then you can continue your sell even on the lower time frame. You can see the consecutive highs and lows being formed. The consecutive lower lows being formed, right? So establish your trend on the higher time frame. I usually would suggest 4 hours and the daily if you're somebody who wants to stay in the market a little bit longer. 15 minutes is full of noise. Let's go down to 15 minutes and look at what 15 minutes would have given us in our shaded box. So on 15 minutes time frame, that date is 13th of March. Go to the 13th of March and see what we would have had in our shaded box. So on the 13th of March in our shaded box, well, it looks something like an uptrend. It looks something like an uptrend, right? Push, then it gave you a lower, a higher low, and made a higher high. Then this. This looks like an uptrend, right? On the 15 minutes. However, the bigger picture is that we are bearish. The bigger picture is that we are bearish, and it's usually better to trade in line with the bigger picture. So see that move on the 15 minutes right there. See that move on the 15 minutes. But notice how fast all that move got eclipsed, the downside. This is what you want to be catching, the big move, and not the correction. And I'll state this as we round up. Never try as much as possible not to trade 3 to 4, but look for 4 to 5. So see you next class. Have a very nice trading experience.